I am AI avatar of CA Ratan Mundra. The International Financial Services Centres Authority, or IFSCA, has recently issued two significant informal guidance letters that provide much needed clarity for insurance and reinsurance businesses operating or planning to operate in GIFT IFSC. These clarifications address practical questions raised by market participants regarding reinsurance activities and the use of managing general agent, commonly known as MGA structures. For many international insurers and reinsurers, regulatory uncertainty often becomes a major hurdle before entering a new jurisdiction. Through these guidance letters, IFSCA has provided a clearer understanding of how specific provisions of the insurance regulatory framework should be interpreted. The guidance is particularly important for foreign reinsurers, insurance groups, investors, compliance professionals, and consultants evaluating opportunities in GIFT IFSC. These clarifications are expected to support business planning, improve compliance confidence, and strengthen GIFT IFSC's position as an international insurance and reinsurance hub. The first guidance originated from a request made by an applicant intending to establish an IFSC insurance office dedicated exclusively to reinsurance of general insurance business. While planning this structure, the applicant encountered concerns arising from the FEMA Overseas Investment Rules 2022. These rules impose certain restrictions on overseas investments in insurance-related activities. The applicant wanted to understand whether reinsurance of general insurance business should be treated separately from general insurance business itself. This distinction was important because the interpretation could potentially impact the permissibility of investments and business structures. Since the Insurance Act contains separate definitions for insurance and reinsurance, uncertainty existed regarding the correct regulatory position. To avoid any ambiguity and ensure regulatory compliance, the applicant approached IFSCA and requested a formal clarification on how the activity should be classified under the IFSC regulatory framework. Before issuing its clarification, IFSCA conducted a detailed analysis of the applicable legal framework. The authority examined several provisions of the Insurance Act 1938, including the definitions of insurer, Indian insurance company, general insurance business, health insurance business, and reinsurance. In addition to the Insurance Act, IFSCA also reviewed the provisions contained in the IFSCA Reinsurance Regulations 2023. The objective was to determine how reinsurance activities fit within the broader insurance classification framework. By analyzing the relationship between different insurance segments and the reinsurance business supporting them, IFSCA evaluated whether reinsurance should be viewed as an independent category or as part of the underlying insurance class. This detailed legal interpretation formed the foundation for the final guidance provided by the authority. After reviewing the regulatory framework, IFSCA concluded that reinsurance can be carried on in relation to various insurance segments, including life insurance, health insurance, and general insurance. The authority further observed that among the insurance segments recognized under IFSC regulations, most non-life insurance categories fall within the scope of general insurance business. Based on this interpretation, IFSCA clarified that reinsurance relating to general insurance business should also be regarded as part of general insurance business. This clarification removes doubts regarding classification and provides a clear regulatory position for market participants. As a result, businesses engaged exclusively in reinsurance of general insurance classes can now confidently structure their IFSC operations, knowing that such activities fall within the recognized ambit of general insurance business under the IFSC framework. To understand the practical implications, consider a foreign reinsurer that provides reinsurance coverage for marine cargo insurance, property insurance, engineering insurance, and cyber insurance. These are all recognized categories of general insurance business. Prior to the guidance, questions existed regarding whether reinsurance activities connected to these products would receive separate regulatory treatment. IFSCA has now clarified that such reinsurance activities remain part of the general insurance segment. This clarification significantly reduces interpretational risks and helps foreign investors make informed decisions. Reinsurers can now establish IFSC insurance offices with greater confidence, knowing that their business model aligns with the expectations of the regulator. The guidance also supports long-term planning by providing certainty on licensing, compliance obligations, and regulatory treatment. The second guidance letter focused on a managing general agent or MGA-based structure. The applicant proposed operating an IFSC insurance office through an MGA arrangement and sought clarification on several practical aspects of the model. A total of 9 operational and compliance-related questions were submitted to IFSCA. These questions covered areas such as reporting obligations, regulatory responsibilities, premium transfers, retrocession limits, investment requirements, taxation, and business closure procedures. Since MGA models are commonly used in international insurance markets, participants wanted to understand how such structures would function within the IFSC regulatory framework. The resulting guidance provides valuable insights into the authority's expectations and establishes important principles that will influence how future MGA-based insurance operations are structured in GIFT IFSC. One of the most important clarifications provided by IFSCA relates to the legal status of the MGA. In many international jurisdictions, an NGA functions primarily as an intermediary that performs delegated functions on behalf of an insurer or reinsurer. However, IFSCA has adopted a different approach. According to the guidance, the NGA and the foreign reinsurer jointly receive the certificate of registration for the IFSC Insurance Office. This means the MGA is not merely an external service provider or intermediary. Instead, it forms an integral part of the regulated insurance office structure. Consequently, both entities become subject to regulatory oversight within the IIO framework. This clarification significantly changes how market participants should view governance, accountability, compliance responsibilities, and operational management within an MGA-based IFSC structure. Another major clarification relates to retrocession and risk retention requirements. The applicant expected greater flexibility in transferring business to foreign reinsurers. However, IFSCA clarified that an IFSC insurance office engaged in reinsurance business cannot retrocede more than 50% of its reinsurance portfolio. This effectively means that at least half of the reinsurance exposure must remain within the regulated IFSC structure. For example, if an IIO writes $100 million of reinsurance premium, it can retrocede only $50 million, while the remaining $50 million must be retained. This requirement ensures that IFSC entities maintain real underwriting substance and are not used merely as pass-through vehicles. The guidance reinforces IFSCA's objective of building the genuine insurance ecosystem with meaningful risk management and underwriting activities within GIFT IFSC. IFSCA also clarified important aspects relating to investments and international business. At the time of registration, an IFSC insurance office must choose between two investment frameworks. The first option is compliance with IFSCA's investment regulations, while the second option allows adoption of the home country regulatory investment regime. This flexibility can be particularly beneficial for global insurers already operating under established regulatory standards. However, IFSCA also clarified that retention and retrocession requirements apply to the entire gross reinsurance premium written through the IFSC insurance office. This means the restrictions are not limited to Indian origin business. Whether the business originates from India, IFSC, SEZs, or overseas markets, the same regulatory requirements apply. This clarification has significant implications for multinational reinsurance groups planning global business operations through GIFT IFSC. The two informal guidance letters collectively provide significant regulatory clarity for the insurance and reinsurance industry. The first guidance confirms that reinsurance of general insurance business falls within the broader scope of general insurance business under the IFSC framework. The second guidance establishes that an MGA-based IFSC insurance office is a jointly regulated structure rather than a simple intermediary arrangement. Key outcomes include recognition of joint responsibility between MGA and reinsurer, application of retention and retrocession limits, inclusion of international business within regulatory restrictions, flexibility in investment regime selection, and mandatory regulatory approval for business closure. These clarifications reduce uncertainty, strengthen compliance expectations, and improve transparency for market participants. As a result, foreign insurers, reinsurers, investors, and insurance groups can now evaluate GIFT IFSC opportunities with greater confidence and a clearer understanding of regulatory expectations. Moon Sales and Management Consultants LLP, a trusted partner for SEZ and IFSC excellence, a pioneer in establishing SEZ and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support, and handling compliances, risk management. Renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF, and ancillary regulations and fintech. Expertise in customs clearance for aircraft and ship procurement, leasing, GST, DHPF, IFSC. A comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network. Scan the QR codes below to stay connected with us.